we remain cautious in terms of our expectation for trans-Pacific trade during the remainder of the 2025. It remains too early to determine whether the surge in the demand we have seen in the last few days represents a return to normalized US-China volumes moving forward. Additionally, the updated USTR rule introducing short port fees on Chinese-built and owned vessels has added another level of uncertainty. We are actively exploring a mitigation plan and assessing the financial impact of the proposed action. As we look ahead, with our core focus on continuing to navigate the highly uncertain geopolitical and macroeconomic conditions, we are confident in our agile approach and competitive position in the industry. Turning now to our financial results. Following an exceptional 2024, both financially and operationally, we began 2025 with a strong first quarter performance consistent with our expectations. Upscaling our fleet and employing larger vessels that have improved our cost structure, coupled with strong underlying demand, once again drove double-digit carried volume growth year-over-year and enhanced profitability. Slide number 4. We generated revenue of $2 billion and net income of $296 million in the first quarter, representing year-over-year increases of 28% and 222% respectively. Q1 adjusted EBITDA was $779 million and adjusted EBIT was $463 million, with adjusted EBITDA margin of 39% and adjusted EBIT margin of 23%. We maintained total liquidity of $3.4 billion as of March 31st, which at quarter end included $382 million paid in early April as a final dividend on account of 2024 results. Slide number 5. We remain committed to return capital to shareholders. Per our dividend policy to distribute 30% of quarterly net income, our board of directors has declared a dividend of 74 cents per share, or a total of $89 million based on Q1 results. Despite the considerable uncertainty, we are maintaining our full-year guidance ranges. To remind you, we anticipate adjusted EBITDA between $1.6 billion to $2.2 billion and adjusted EBIT between $350 million and $950 million, with better performance still expected in the first half of the year versus the second half. Xavier, our CFO, will provide additional context and our underlying assumptions for our 25 guidance later on the call. Slide number 6. Against the backdrop of the uncertainties I mentioned before, planning is internally difficult, but we remain committed to a proactive approach. We continue to take steps in line with our strategic objectives that further enhance ZIM business resilience, both commercially and operationally, and competitive position in the industry. Over the past several weeks, we have adjusted our network, underscoring the agile nature of our commercial strategy. Our actions are a response primarily to changes in the Trans-Pacific demand as evolving U.S. tariff policy impacts global trade. Initially, in coordination with our partner, we modified our service rotations to mitigate the impact of the drop in export from China to the United States, while ensuring we maintain extensive port coverage to uphold our service commitment. In light of last week's development, we are again realigning our network to account for a return back to more normalized China-US trade relations. Similarly, we have also reversed our initial decision to suspend our ZIM Central China Express line ZX2 service, illustrating again our agility to react rapidly to changing market conditions. In terms of other demand trends in the region, during this period, we have seen improved volumes from other Southeast Asian markets such as Vietnam and Thailand, where we have a strong foothold. In recent years, we have expanded our position throughout Southeast Asia to benefit from the growth in manufacturing in the region and to diversify our business. This strategic positioning helped ZIM capture volume to partially compensate for the decline in Chinese cargo to the US during the beginning of the second quarter. We are adopting a similar strategy in Latin America to diversify our operation and increase our business resilience. We are strengthening our presence in the region to take advantage of the anticipated growth in trade between Latin America and the United States, as well as China and the region. Overall, the primary point to highlight is that ZIM has long recognized the importance of taking nimble approach to fleet deployment, identifying new growth opportunities and leveraging our commercial agility have been and continue to be a core strength for ZIM. We continue to maintain flexibility at all times to reshuffle vessel capacity based on demand. We expect to continue to react in changing market conditions as dynamically as possible. Our commercial success and improved profitability have been made possible by our transformed fleet. After receiving all 46 new builds we contracted in 2021 and 2022, which significantly improved the efficiency of our operated capacity, we entered the new year deploying larger, modern vessels well suited to the trade in which we operate. After growing our operated capacity for 2 years, we have regained optionality, which allows us to adapt ZIM capacity as market conditions change or our commercial strategy shifts. Moving forward, our goal has been to maintain and further enhance our competitive position while capitalizing on attractive opportunities that will ensure our fleet remains modern and cost-effective. Consistent with this long-term approach, we recently secured 12-year charter for 10 11,500 TEU new-build LNG dual-fuel container ships from an affiliate of the TMS Group. This charter agreement will ensure access to an important and versatile vessel segment that is generally unavailable in the charter market and ideally suited for several of our global trades, enhancing our commercial agility and advancing our growth strategy. This also represents a strategic investment in our core LNG capacity, which serves as a critical commercial differentiator for ZIM As we expect, it will be commercially valuable with the growing demand from customers for eco-friendly shipping solutions. This vessel will also support our long-term decarbonization objectives. ZIM was an early adopter of LNG technology, which has helped us achieve significant milestones in our ESG journeys. As we highlight in our 24 ESG report, which we plan to publish shortly, we reduced our carbon intensity by 16% in 2024 compared to 2023. Moreover, in 2024, we surpassed our 25 target of a 30% reduction versus the 21 baseline, reaching a 35% decrease. We remain committed to ESG as a core value, and in this report, our 7th, we detail ZIM decarbonization roadmap toward net zero by 2050, together with a comprehensive overview of our ESG initiatives, achievement programs, and updated targets. Overall, we remain confident in our strategy and competitive position in the industry. We enter 2025 with a transformed fleet of cost and fuel-efficient capacity, approximately 40% of which is LNG powered today, and are pleased to have taken steps to advance our fleet strategy for the future. Our nimble commercial approach, together with the prudent investment in our fleet, equipment, and technology, continue to drive resilience in ZIM's business. On this note, I will turn the call over to Xavier, our CFO, for a more detailed discussion of our financial results, 2025 guidance, as well as additional comments on the market environment. Xavier, please go ahead.
Thank you, Eli. And again, on my behalf, welcome to everyone. On the slide 7, we present our key financial and operational highlights. Our strong Q1 results reflect our success upscaling our fleet, supported by positive underlying demand trends. ZIM generated in Q1 revenue of $2 billion, a 28% increase compared to last year. During the quarter, our average freight rate per TEU was $1,776, a 22% increase year over year, though 6% lower than the Q4 average freight rate of $1,886. Total revenues from non-containerized cargo, which reflects mostly our car carrier services, totaled $114 million for the quarter, compared to $111 million in the first quarter of 2024. To remind you, since November 2024, we have been operating 15 car carrier vessels. Our free cash flow in the first quarter totaled $787 million, compared to $303 million in the first quarter of 2024. Turning to the balance sheet, total debt decreased by $150 million since prior year end. Throughout 2023 and 2024, our total debt increased, mainly due to the net effect of receiving the new build capacity, namely larger vessels with longer-term charter durations attached. This trend is now reversing, as repayment of lease liabilities is higher than new liabilities being incurred. Next, the following slide provides an overview of our operated capacity. Eli had already discussed certain aspects of our fleet strategy, and I would like to highlight a few more data points that we believe are important to underscore when thinking about ZIM's fleet. ZIM currently operates 126 container ships with a total capacity of approximately 774,000 TEUs. Around two-thirds of this capacity comes from the 46 new build received during the last 2 years, 2023 and 2024, which carry charter duration from 5 to 12 years, and also another 16 vessels that are owned by ZIM. To remind you, we opted to secure our new build capacity on long duration contracts rather than continue to rely on the short-term charter market, and that to ensure that we have secure access to fuel efficient and cost competitive tonnage. We view this our core capacity, and as such, maintaining flexibility with respect to this capacity is a secondary factor. 25 of the 28 LNG vessels carry a charter period of 12 years, creating a predictability in our cost structure. Moreover, we hold options to extend the charter period for these vessels, as well as purchase options, giving us full control over the destiny of these vessels, very much as if we were the vessel owners. We have a similar agreement for the 10 11,500 TEU dual-fuel LNG vessels we recently committed to, with a charter period of 12 years and options to purchase the vessels at the end of the charter period. The remaining one-third of the capacity that we operate, approximately 260,000 TEUs, allows us to maintain important flexibility. By the end of 2026, there will be a total of 44 vessels up for charter renewal, with 22 vessels or 81,000 TEUs up for renewal in 2025, and another 22 vessels or 74,000 TEUs in 2026. This optionality to keep the capacity or we deliver to owners allows them to adjust its capacity according to changing market conditions or shifts in our commercial strategy. Longer term, our focus is to ensure that we maintain and continue to enhance the competitive position of our fleet. Now turning to additional Q1 financial metrics here on slide 9. Adjusted EBITDA in the quarter was $779 million, or 39% EBITDA margin, compared to $427 million in Q1 2024. Adjusted EBIT was $463 million, or 23% margin, compared to adjusted EBIT of $167 million in the same quarter of last year. Net income for the first quarter was $296 million, compared to $92 million in Q1 2024. Next, you will see that we carried 944,000 TEUs in the first quarter, compared to 846,000 TEUs during the same period last year. That represents an increase of 12%, well ahead of market growth of 4.5%. Our Trans-Pacific volume grew 11% in Q1. It is important to reiterate that we maintain flexibility to reshuffle vessel capacity as the market evolves, driving resilience in our business. Notably, we achieved a 22% year-over-year volume growth in Latin America in this first quarter, and we anticipate further increasing our market share in this trade as we continue to strengthen our presence in the region. Next, here we present our cash flow bridge. For the quarter, our adjusted EBITDA of $779 million converted into $855 million of cash flow generated from operating activities. Other cash flow items for the quarter included $582 million of debt service, mostly related to our lease liability repayments. Debt service in Q1 cash flow includes $72 million reflecting repayment of lease liabilities related to the 2 second-hand 8,500 TEU vessels we acquired in the quarter, as well as the down payment for the last remaining LNG vessel that we received in January. Moving now to our 2025 guidance, we have reaffirmed our outlook and expect to generate adjusted EBITDA between $1.6 billion and $2.2 billion, and adjusted EBIT between $350 million and $950 million, with the second half still expected to lag the first half. We have maintained wide ranges reflective of the high degree of uncertainty related to global trade and geopolitical issues. Before touching on our underlying assumptions regarding freight rates, volume, and bunker costs, I would like to update on our contract volume. As can be expected, contract negotiations this year were affected by the uncertainty regarding tariff levels. And as such, the new annual Trans-Pacific contracts, which went into effect on May the 1st, represent approximately 30% of our expected Trans-Pacific volume for the coming year. Somewhat similar percentage to the one of last year. Our view on freight rates and operated capacity are unchanged as compared to our guidance assumptions from March. We expect freight rates to be significantly lower in 2025 versus 2024, with average freight rates in the remainder of 2025 lower than Q1 average. Also, we currently assume the sailing through the Red Sea will not resume this year, continuing to absorb significant capacity. We assume that we will maintain similar operated capacity on average to that of 2024 over the course of the year, as we renew some of the existing capacity or similar tonnage, though at lower rates than those fixed in 21 and 22. As such, we expect to continue to see an improvement in our cost structure. Given our exposure to the Trans-Pacific, we revisited our volume growth assumptions and now assume low single-digit volume growth year over year. Finally, as for bunker costs, we now expect slightly lower cost per ton in 2025 when compared to 2024. Before we open the call to questions, a few more comments on the market. The current environment is marked by a range of factors greater and more diverse than ever, which significantly impact the supply-demand balance we typically track to assess the health of the industry. The expected growth in capacity is known. The current order book to fleet ratio is significant, approximately 29%, or about 9 million TEUs of equivalent capacity. But there are mitigating factors to consider with short-term and long-term impact. First, the delivery schedule for this capacity is spread out over the next 4.5 years, with more modest deliveries in 2025 and 2026. Scrapping has been minimal in recent years, and projections for the coming years are also low, resulting in an aging fleet. At some point, scrapping should catch up. Also, the industry's decarbonization agenda and the need to meet stricter emission targets or customers' expectations will also require a higher pace of fleet renewal and could spur further scrapping. Yet, the most significant factor impacting supply today is exogenic to our industry, the rediversion around the Cape of Good Hope. As the current consensus is that we will continue to do so for the coming months, the outcome for 2025 are likely to be mostly demand-driven, namely when and how we see resolution on US tariffs. Last week's agreement by the United States and China to bring down the level of mutual tariff for a 90-day period is a positive step and will allow demand to recover, at least in the near term. It could also be viewed as mutual recognition by both sides of the need to reach an agreement. The efforts of the current US administration to address its trade deficit are not yet resolved. The tariff rates that will ultimately be established between the United States and China, as well as other US trading partners, will determine whether demand can return to previous levels or whether tariff levels will establish new trade barriers. Equally important is the timing of these agreements, as the ongoing uncertainty on tariff levels impacts purchasing and, as a result, booking decisions, leading to possible disruptions within the supply chain. Notwithstanding these tariff actions will motivate trade and manufacturing diversification, as both the US and China will most probably seek to reduce their mutual dependency. This in turn will further complicate supply chain management, which could present both risks and opportunities for our industry, and also require further investment in inland and port infrastructures, which, if insufficient, could hold higher potential for disruptions. Thank you. And on that note, we will open the call to questions.
At this time, I would like to remind everyone, in order to ask the question, please press star, then the number 1 on your telephone keypad. We will pause for just a moment to compile the Q&A roster. Your first question comes from the line of Muniba Kayani with Bank of America. Your line is open.
Thank you for taking my questions, and thank you for the detailed commentary around what you're seeing in this market environment. So firstly, on the market side and demand, what are you hearing from customers in terms of inventory levels right now? And we clearly have seen the surge over the last couple of days. Are you kind of expecting possibly an early peak season in ocean shipping this year and then a slower end year end? Just wanted to understand some of your thinking and feedback from customers. Second question around the Red Sea. There was some news recently that the Suez Canal expects, the authority there expects liners to resume transiting through the canal within a month after they offered some discounts on those fees. So I think you just said that you don't expect it to open. So how are you thinking about that situation currently from an industry perspective as well as from a ZIM perspective? And if I may ask a third question, totally understand maintaining your guidance at this point, but now with 1Q behind you, and you clearly said that the 1H second half comment, can you give us a sense of where do you think you'd be at this point landing up within your range, upper end or lower end, midpoint? Thank you.
Thank you, Muniba. Starting with your first question with regards to the market, the demand, what do we hear back, the inventory levels of our customers? Clearly, I mean, we've seen ups and downs in the market over the past few weeks, in line with the changing situation with respect to tariff. So if we go back a little bit in time, when the 145% tariff barrier was announced not so long ago, a few weeks ago, 5 to 6 weeks ago, that had a clearly significant immediate effect in reducing and canceled the bookings that we've experienced. So the volume of cargo being moved out of China went down meaningfully from almost one day to the other. So as a result, clearly on the other end, on the receiving end in the US, retailers have had to tap into their inventory levels in order to continue to offer products to their customers. And there was always a debate and a risk that if the situation was to remain as is, at some point inventory would dry out and the risk of empty shelves in the US was looming around. Now, the recent announcement of a pause in the 145% tariff had also an immediate effect to somehow revitalize the demand, and pretty much all the shippers were willing to bring cargo as quickly as possible for many reasons. Because of the threat of no longer having inventories, I believe is one, but also because the window is for now known of being 90 days, and what will be thereafter is still very much unknown. So I think everybody is trying to take an opportunistic view here in this respect to try to move cargo during the times when the effect of the tariff are potentially minimum. So does that mean, and you're right in saying that from a timing perspective, this is potentially not too far away from the start of the peak season. Maybe we are a month in advance here in this respect. Time will tell. I think the more important element that will allow us to have a more definitive view as to how volume can look like for the second half of 2025 will be very much where will we land from a tariff discussion perspective once the 90-day pause has elapsed, which is now coming up soon, July 9th. With respect to your second question, the Red Sea, yes, today we are of the view that it is more likely than not that in light of the current situation that continue to prevail in the Middle East, the Red Sea canal will not be used by the industry for the foreseeable future. I think, and we are, of course, well aware of the incentive that the canal authorities have conveyed to the market, trying to attract capacity back to the canal. The way we look at it is clearly for us, we will only come back to the canal when we are certain that it is safe to do so. We will not take any risk with our seafarers. We will not take any risk with our assets in terms of vessels. We will not take any risk with the cargo of the customers that we carry. And also importantly, we will not just give it a go and try, because what I think is important to remember is that now we have a stable network going around the Cape, and if we were to return, and when we will return to the Red Sea, this in itself needs to be for the longer time. We cannot go in and out and assume that this is neutral to the repositioning of the vessels and the effect that it has on our network. So that's why for us it is not really a tariff discussions or a canal fee discussion. This is not what is preventing us today from crossing the canal. It's very much the safety concerns that we believe are still extremely high. And then to your last question on the guidance, I think you will agree that it is extremely difficult today to have a clear view as to how the situation will be like, especially again after we've gone through the various milestones that are ahead of us. I mentioned July 9th, which is a key date where also the discussions on the tariff levels that will potentially prevail for all the countries but China will potentially also change. We will get to the end of the 90-day period. August 14 will be the end of the 90-day pause on the China tariff. So those key dates are still ahead of us, and depending on what will be the outcome here, will have a significant potential effect on the financial performance of the company going into the second half. So that's why we kept a wide range of options in terms of guided figures, both for EBITDA and EBIT.
That is clear. Thank you.
Your next question comes from the line of Omar Nokta with Jefferies. Your line is open.
Thank you. Hi, Eli and Xavier. A couple questions for me. Xavier, you mentioned the 2025 contracts on the Trans-Pacific will be around 30% of volumes, like they were last year. Back a couple of months ago, you mentioned you had a bit more of a constructive negotiation period, and that sounded like you were going to go back to maybe a 50-50 spot versus contract. We know obviously a lot's happened between March and May, but can you give color as to maybe what happened or what drove the decline in that expectation, going from 50-50 down to 30-70?
Sure. Thank you, Omar. Look, I think what I should start by saying is that this year, just like last year, when we go into those discussions with our main customers on the Trans-Pacific trade, the state of mind has been the same. So we were indeed open to up to 50% contract and remaining exposed to 50% to the spot market. But also, and just like last year, we had a minimum rate that we were not willing to compromise on in terms of expectation, a rate per customers that we believed was the fair rate for both parties to agree and settle at. Clearly, the discussion this year were very much also affected by the current market uncertainties with respect to the trade and tariff discussions. So we also had some of our customers that were more on a wait and see mode, and this is why, again, at the end of the day, the outcome is the one I mentioned that for the reason I explained. From a customer perspective, maybe a little bit willingness to wait before to commit, and from our end, also the clear instructions given to our commercial team to not go below certain rates that were pre-agreed internally, led to this outcome of a 30-70% split.
Okay, thank you. And then just kind of shifting a little bit maybe towards just volumes and expectations. You're talking now for 25 low single digits versus single digits initially expected. I know it's not a substantial change, but wanted to get maybe if you could qualify what's behind that. Is that because of what you saw in April, and so you've adjusted accordingly, or is it more perhaps more modest outlook for the remainder of the year?
There are two things here. First of all, I think when we look at our volume in Q1, we are very pleased with the 12% volume growth year over year. However, initially we had expected a little bit more than what we delivered, and we faced the a few weeks after Chinese New Year, the recovery of volume in and out of the US was took a little bit more time than what was initially anticipated. So that's one, and this volume that we did not carry in the first quarter may not be caught up in the future ones. And the second element is also, as you know, we've transitioned to a new partnership with MSC, working away from the 2M, and that transition as well has a little bit of effect in the overall utilization of the fleet, and that contributed as well to a little bit less volume being carried. So that the conjunction of those two elements, I think, explain what has happened between now and May. And now also looking forward, we clearly do see a pickup in the demand from cargo movement between China and Asia to the US. We also, as Eddie mentioned, did take decisions to redesign and adjust our network not so long ago. We are now canceling those decisions and bringing the capacity back. So that also has a little bit of an effect in the overall utilization of our fleet as we need to reposition some of the ships. So that's mostly why overall now we are a little bit more conservative in our volume assumptions for 2025 when compared to what we communicated earlier on in March.
Okay, thank you. That's clear. And then the final quick one, perhaps, and then I'll turn it over. Are you able to give, what portion of your Trans-Pacific volume is direct China-US related?
You mean out of the Trans-Pacific, what is the weight of China in our loadings? Is that the question, Omar?
Yeah, just basically the bilateral relationship, China-US, US-China, of that portion of the business, perhaps maybe in 2024.
Yeah,
that's the ratio was.
Yes, that's the significant majority of the cargo that we move originates from Asia to the tune of 60 to 70%. The rest would be Southeast Asia, neighboring countries, Vietnam, Thailand, Korea, you name it.